thank you for sticking around. We're going to talk a little bit about Reg A. Hopefully we can make this real collaborative. We didn't do a ton of prep, but we did enough. I think everybody here on the panel has had some involvement with Reg A deals, whether it's marketing or accounting, banking. So I myself, just real quickly, I've been in the publishing business and data collection for about 10 or 12, maybe 15 years. And have covered all types of topics like the marijuana space, like lots of deal strategies, pipes and reverse mergers, and of course Reg A. Most recently, I have been focusing mainly on lending, specifically small company lending, and figuring out how to create a little bit more efficiency in that market by aggregating data. So I guess everyone on the panel could introduce themselves, and we could start right here on my right with Ted from MZ.
Sure. Yeah, my name's Ted Haberfield. I'm from president of MZ North America, which is a full-service investor relations firm. I'm also a licensed rep over at Primary Capital, so I see it from both the IR side and on the banking side. So.
I'm Michael Quinavala with Maxim Group, full-service broker-dealer. I work in the investment bank division. And we see Reg A as a growing space that we're eager to become a part of.
Evening, everyone. My name is John Hughes. I'm a director over at Markham LLP. We're a top 15 public accounting firm in the country. Deep roots in the microcap community, which was an easy bridge into the Reg A space when it became legal almost 2 years ago at this point. So. Okay,
good. We kept it brief. Why don't we just start with, a little bit of kind of market perspective. We haven't seen a ton of successful deals, I think, since Reg A went live again. We've seen something like 29, I think, deals as of February for about $400 million in total. Most of those companies, I think, have been related to real estate. But in terms of what you guys are seeing in the market now and what you think, is going to perform well as a Reg A deal, why don't we just start with you, Ted, and we'll just kind of kick it around.
Yeah, sure. So I would say that actually up until fall of this last year, it was pretty darn quiet. People are still swimming through trying to understand the different aspects of it, the different titles of it, what classifies. Should I do a two-step? Should I go 506C? Should I go straight to Reg A? And then looking at a graph and just getting cross-eyed trying to go, what are we going to do here? But at the end of the day, the demand comes from the risk appetite of the end investor, right? And so with all that's happened with Trump economics and all that kind of stuff, you've had the risk appetite increase significantly. Therefore, there's a lot more players pushing and demanding to getting involved in these types of deals. So I would say since November, December, it has increased significantly just from that demand, which makes folks like us react more. So I don't know if that addressed your question.
Sure.
I totally agree that it would slow it at first, mainly because people weren't confident with Reg A. They didn't know that this is going to be around. What are the rules? I mean, it took 3 years just to write the rules, and now we're a year and a half later, and it moves slowly. But the interest in it is taking off, and better issuers are coming to the table to look at these deals. It's not simply a cheap way to raise capital, go to a tech company and think, oh, I can raise capital very cheaply, very easily without any input. There needs to be a marketing campaign. There needs to be an investment bank or somebody holding the issuer's hand and telling them, this is your real valuation. Here's how we're going to generate interest.
I have a similar conclusion and similar point to make, a little different perspective, because once the rules got finalized and approved in June of 15, we at Markham, we started to get calls about doing the audits. So we were there pretty early on with the initial companies that wanted to take a shot at this. And same conclusion. I don't think it's an unknown story here. It's been rather slow. No one's. I don't think anyone's really come close to closing on the full $50 million of Tier 2. I think initially the companies that thought it would be a great idea was, maybe that typical company that was going to do a crowdfunding campaign, and these new rules passed, and they thought to themselves, I'll skip the crowdfunding campaign. I'll just go raise $50 million for free. And I don't know if it's quite turned out to be that way. At Markham, we've been the auditor of a number of Reg A filers. Some have closed small amounts of capital, $1 to $5 million. We have a number of ongoing ones right now, which is probably similar to what everyone else is seeing, that are trying to close the $50 million. So I think it's wait and see. I think everyone's still pretty optimistic about it, though. Now that the different types of companies, like you mentioned, or maybe a more mature company, a more sophisticated company, that instead of a company that was going to do a crowdfunding campaign, maybe this is a company that was going to file an S1, but now they're going to go a different route and use the test of waters or something like that. I think different types of companies are starting to see it be appealing. So I think there's still a lot of cause to be optimistic.
Yeah. One of the things that I have found is kind of cool about Reg A is, there's a merchandising element to it. And I think the companies that are successful with a Reg A deal, separating the real estate assets, are going to be those that have a product that the average person could kind of relate to. I found myself on a conference call with a couple of consultants and maybe a banker and a company that had created, or I guess was creating, what they were describing as an alternative to Botox. I can't remember the name of the company, but it was for wound healing primarily, like you relax the muscles around, recent surgical procedure, and it allows the wound to heal quicker. And one of the consultants started telling the company, we're going to send out emails and we're going to call it, the next great Botox, but it's better than Botox and lasts longer than Botox. And I got off that call and I thought, shit, this is a real problem, because you can't merchandise a compound in a petri dish like it was Botox. And so, for me, that was kind of, a bit of a realization that for a lot of companies that are maybe, esoteric type businesses, heavy on tech or heavy on pharma, that it might not be a great path unless you've got a real meaningful kind of institutional backstop on the deal. But I'm watching them closely. Ronco, I guess, just filed to do a Reg A, and it got good play on Yahoo Finance and some other mainstream outlets. And if people could relate to spray on hair or rotisserie chicken ovens, whatever they're doing now, then maybe they'll be successful. But I do think that's kind of the coolest aspect of it, is the whole merchandising component.
I want to add.
What was the company called?
Ronco.
How do you spell it?
RONCO.
I want to add to that too, because as an issuer, if you're an issuer here, as we swam through what would be a good candidate for a Reg A or 506C was companies that had a consumer product-oriented retail component. And the reasons were, as from a cost perspective. And what I mean by that is that they have the built-in database of end users that they can go out to. Whereas the ones that don't qualify right out of the gate are ones that do not, because they have to go out and market their deal on their own, which when you start to hear market your deal on your own, big dollar signs go up. So these companies now are playing more of a role as the demand for this structure is increasing, and they're actually going out, and there are databases now available because there's been enough Reg A deals that have gone done that there's sophisticated marketing companies that will then sell and, for lack of a better word here, promote or market their Reg A deal. So you don't necessarily have to be now a company that has product-oriented end users that are going to do $1,000 or $500 or $5,000 investments into these deals. So I thought I'd bring that up. If you're an issuer, you don't have to necessarily have this huge database. The marketing dollars do have to be budgeted. And let me give you an example. There's one company that did a $10 million raise, had no end users, no database, no emails. They went out and actually marketed and did put together a $1 million budget, like $1 million. and they were able to get off of that $1 million a 10-for-1 ROI on those marketed dollars. So if you can come up with $1 million and get an ROI like that, you got to find obviously the right marketing firm and so forth, and the right IR and all that stuff to complement it. But that's a pretty significant raise based on a very orchestrated, very precision targeting type of outlay.
I couldn't agree more that this is the marketing aspect of Reg A is the big piece, and that's part of the failure, I think, too, in the early stages was I think only 35% or so of the companies out there were revenue generating. So no one knew who they were. They didn't have the data to feed off of. And now as the crowd matures, as the issuers mature, they can use Reg A as a growth tool. They can market to the people who already love their product. They can reach out to databases that are established, just like you talked about. And it provides a launching pad for young, growing companies that they didn't have 2 years ago.
Yeah, I think that when Reg A really starts to take is when you have venture capitalists looking at it for portfolio companies. Maybe a company that was considering a sale or maybe considering a traditional IPO. And when the venture guys get behind, this structure, I think you're going to start to see a better flow of companies. I mean, to your point on, earlier stage companies, even like with real estate, the deals that I've seen that aren't very attractive are kind of those blank check blind pools where you've got managers who say, these are the types of real estate assets that we've purchased in the past, and we're going to do exactly what we did do, give us money. I mean, to me, that's not really an operating company. That's not as attractive as, an ongoing business. And in the case of real estate, maybe one that puts assets into their Reg A deal. But I think over time, it will change. And Ted, to your point on kind of marketing lists and all that, there is added sophistication in some of the marketing now, where there are a couple of upstart consulting type groups who are running test campaigns based on LinkedIn and based on Facebook and based on different email data sets to figure out what that return on your marketing dollar is going to look like. And I think over time we'll have probably more statistics to work with. And if you're a company that is similar-ish to another company, that pulled off a successful deal, then I think that'll work. So yeah, pretty optimistic long term. But I think in the near term, everybody is a little bit frustrated with the lack of real quality deal flow. Probably more deals that fall into that category, which I was explaining before, where you've got a very technical company that thinks they're going to make some mass appeal to retail type investors. I just don't know how that's going to work. I don't know what color on the email or what font selection or what time of day you need to send it to get like massive conversion metrics. I've been list marketing for 10, 15 years, and it's tough to get opens and click-throughs and ultimately, a purchase. And in an investment, the psychology of making an investment is much different than the psychology of selling a conference ticket to the marijuana event in Midtown. There's this kind of emotional attachment. Nobody's waking up in the morning saying, I'm going to buy stock in a biotech doing a Reg A deal. So I think that the selection of companies is going to be key. And Mike, to your point, which is why we're working together, I think that the marketing is going to be everything, and having a banker that kind of pushes through the process, recognizing that email won't suffice. You have to create a mechanism where if you've got inbound interest, that there's a banker, like I know the guys at Primary are working on something where you have people actually selling stock, because again, no one wakes up thinking they're going to buy into a deal like that.
Let me comment to that as well. Yeah, so let's say that you've got marketing and you've got 5,000 people that have taken an interest, whether it's through clicks or however you ended up getting there. They're going to be led to a web portal 9 out of 10 times that will allow them to walk through and actually do it on their own. 70% of them will be able to handle it fairly easily. The 30% are usually the older generation that said, I don't even care, I don't want to deal with a portal, right? I need to talk to somebody live. That's where your communications, your shareholder communications plan has to be intact, and why I'm not going to mention companies that have failed, actually missed out on millions and millions. I mean, I'm talking not just one or two, I'm talking like 10 to $20 million worth of a miss because they didn't have enough people resources in place to accept an incoming call if someone says, hey, look, I just want to talk to somebody live, make a couple of confirmations, and give me some instructions. As a non-licensed, non-securities firm, you can show somebody the way. But then if you start to solicit and they can't understand even how to use the portal, that's where the investment banking or licensed firms need to be integrated to where you can actually open up an account for them and carry through. The infrastructure has to be built in order to accept this type of inflows of calls and interests in order to effectuate it.
I just want to echo that. I couldn't stress it enough how, although it might only be 30% of the people who struggle with the portal, that 30% is the more elderly investor who has more money to invest. At this point, you need that money. Those are the wealthy accredited investors who are going to drive these deals from being 1 to 5 million deals, hopefully to 10, 15, or $20 million deals. And you need someone at the end of the line to coach them to that practice. Maybe 5, 10 years from now, the 30-year-old who had no problem with the portal, they'll then be the wealthy investor. But until that occurs, let's maximize every marketing dollar and convert the wealthy investors as well.
And I think early on, I'm not even sure how easy it was for the 70% to get through the initial portals that were set up for some of the offerings. I think that'll get cleaned up as well as these deals get more and more mature and routine.
Yeah, I mean, right now, and I guess I don't have any real hard data to support this, but I would have to imagine that the abandon rate on those web pages is pretty high. I mean, I've gone through like that preliminary indication of interest process, and when you get to, name, email, okay, that's fine. Investment amount, okay, it's $1,000. And if the next screen is asking for my social security number and I have no relationship with this company, I'm not going through that form. So my take is that, for this to start to gel, you need a bank involved and you need to keep that kind of hook relatively shallow. Like, tell me who you are, give me an email and a phone number, and then you can have a broker call that person and explain the deal before you're going to frighten them off by asking for, real personal information. And I think that will eventually happen, that people will realize that as long as you're using mass marketing techniques like email, the conversion statistics are everything, and if you're marketing conference tickets, there's a lot of data that you could rely on and you could figure out when is a good time or bad time to send email. But I think right now on deal marketing, the key will be, the selection of investor prospects that you reach with a marketing communication and how you handle people who show very, very preliminary interest. I do not see, I personally, I think that the deals have to be banked, and the better deals have to have some institutional, firm behind them, because I think too many companies that are getting advised to go the Reg A route are going there because they've probably beaten a path, up and down Wall Street and the Boston corridor, if they're a bio company or whatever, and the venture investors have told them go away, and now they got some consultant who's probably an unregistered guy saying, well, you could do Reg A, and that is a huge red flag, because you can't assume that the dumb money is just going to go pouring into your deal. It's just not going to happen. So I think, from the perspective of bankers and real service providers looking for companies that are going to do real deals, get the money and then make money for their investors, I think that you look for the same things that you would look for in any real institutional type of a deal. Some smart money, a firm that knows the process, that can kind of push some of the stock. Anyway, okay, I'm going on and on. What about some of the accounting issues, John? We don't have any lawyers on the panel, so maybe we could just gloss over the legal stuff. But what are you seeing on the accounting side?
I don't know if it's I don't know if there's much of on the way of issues. I'm sure it's old news here. I think we're all talking about tier 2 offerings. There's an audited financial statement requirement there. There are some modifications. There's some differences between the rules that exist for if you're going to do a 33 filing, an S1, versus doing a reg offering. But the audited financial statement requirements are still there. You do get more time for staleness. You get 9 months, so you can file financials in your 1A. You get 9 months to use them and get your 1A qualified. So there are some perks to going the 1A route and doing a Reg A offering from a cost perspective from the accounting side. I would think most Reg A filers are seeing cost savings on the auditing and accounting side versus if they were going to do a full blown S1, which I'm sure is one of the positives that's come out of this. I know we have had to be competitive in the space, and there's a lot of other firms out there that can do it as well. So not so much issues from an audit and accounting perspective. I won't bore everyone. It's pretty routine stuff, but there are some perks to the filer if you do go the route of Reg A from a financial statement perspective.
Yeah, I'll ask this question, and I don't mean it to be funny, but will you give a discount to a company considering a Reg A? Just because you want a
we're
real
on
good
camera. I
Reg
can't
A
answer
deal?
that. We're on camera.
Like
I can't answer that question. We're on camera. No, we know. I mean, we've had to learn about the market, and we've had to learn about the market, and our pricing has to be competitive. End of story. Otherwise, they're going to have to go a different route.
And I guess this is for all you guys. We watched the reverse merger business kind of drop off the cliff a few years ago. Is Reg A competitive, I guess, to some degree? Like, have you talked with private companies that maybe would have done a reverse merger that are now looking at Reg A as an alternative? Like, what's your sense in terms of the inventory?
Well, I mean, you got a question, the first question is why did reverse mergers fail? If we answer that, it's really, being surprised by the amount of supply of stock from legacy or stock or the shareholders that burn people. Bottom line. So, will that exist in Reg A? I don't think so, because it's not set up that way. So I think your question was alluding to, maybe after those shares or those kind of bad actors have been flushed out, now they're looking for alternative ways of financing. Yeah, of course, I think there would be good candidates for it, but I'll let these guys respond.
We haven't seen that yet, but I think Reg A has to mature a little bit before it becomes alternatives for any other type of any other alternative structure. Right now, I think institutions and big money investors are still getting used to this new process and accepting it as fully legitimate. There is some institutional interest now. There are higher quality issuers, and I think it's going to accelerate. But at this point, I don't think that's a substitute.
Yeah, no, I don't see the correlation with reverse mergers and companies doing Reg A deals, other than SPAC reverse mergers, which different panel. I have, reverse merger market's kind of pretty quiet. So.
Yeah, we were years ago also publishing in that space, and occasionally I'll hear of interest from guys doing looking to do a reverse merger, and it seems to me like they still fall into, the deals again that I think will be successful as reverse mergers. I think fall into the biotech sort of category, more technical deals. A lot of institutional money that'll come in at the same time that the merger closes, all kind of contingent upon each other, which is the way those deals historically have been structured. But I haven't watched the business, so I kind of, just ask out of, I guess, semi-ignorance. Why don't we take a few questions if people have questions or are interested in, yeah.
Is Reg A and 506C, is there a requirement that you have to give equity, or it could be a debt funding, or it could be what kind of instrument?
Okay. The question relates to what sort of instrument or security you could use in a Reg A, and you also ask about a 506C deal, which I think is technically considered a private placement, and I think FINRA will consider Reg A public distribution. So, yeah.
It's pretty much anything except an asset-backed security. It could be common stock, preferred stock. It could even be debt. So they have some options.
I see. And what about if you give like a device like those crowdfunding Kickstarter stuff? Hey, if you put $100 each, and then you're gonna get this product delivered to you.
Well, that's not Reg A. That's crowdfunding.
Yeah, but
That'd be like Title III
Ronco
or
is
something
doing
like
that, I think, actually. I think that
To-
Ronco may be doing that.
To your point, yeah, Ronco is doing that. You'll see in some of the filings they offer tiers investment, but I think that detracts from the legitimacy of the offering. You're offering equity in a company. I think that's a significant enough draw if you are a good company. I don't know if those little perks are really going to add much.
But Ronco is offering equity plus you get something in return, a product.
I think you get a free rotisserie chicken.
But if you don't give them equity and you just give them free whatever, and you're just, let's say you're selling water.
Yeah, I think that would, I don't need, that's not a security.
And it's just crowdfunding, you're allowed to do that.
Yeah. Right, and then you mentioned 506C, which has similar attributes because you're talking about public solicitation, and which I think is really, like, that to me was the best thing that came out of the Jobs Act. Like, for my own company, I went out, I raised money under 506C. I put 5 investors in my most recent deal, all 5 of whom I found through 506C email marketing. A couple of the guys I knew, but I never would have thought to call them to invest in my deal. So to me, that whole idea of being able to market a private placement to anyone, but only accept an investment from someone who's accredited, that to me just feels like it makes a lot more sense than not telling anybody about your deal unless you know them. And then allowing them to check a box when they invest. So I mean, I have a hard time believing that as time goes on, if the rules don't sort of merge a little bit, that private placements will all be done under 506C. It just, I don't understand why you wouldn't do it that way.
I'll comment to that too. Most of the times we end up recommending a 2-step where you use the 506C and you keep that open and then get into your Reg A for those reasons.
506C also a great way of building a database of your wealthy investors. Those are the accredited wealthy investors that are really putting significant funds into your company and then converting them from the 506C. At another stage, maybe they want to invest into Reg A.
Yeah, I mean, I think where it really starts to this we'll call it Reg A business really starts to move is where you got a broker dealer with a Rolodex of contacts. You start to understand the preferences of the investors who are part of that Rolodex, and then you offer them what amounts to IPO shares in interesting companies by really knowing who you're targeting. So a guy like me, I have no interest in or knowledge about healthcare. So when websites who run a healthcare Reg A 506C deals email me all the time, invest in this biotech, invest, it's just so silly. I mean, they're going to fatigue me on their list. And it's just they're not going to get those conversion statistics. So I think it just comes back to, will general solicitation work? It will work. I mean, I've personally seen it work for myself, and I've been involved in other campaigns. But I think that the deals that are going to be the most successful, the biggest, most meaningful deals, will be backed by some bank. And companies that are being pitched by or advised by consultants who are unregistered and, instead of paying a brokerage fee, we'll do it all on Facebook marketing. I just think they're totally out of their minds. And it will take time before they all realize that.
But isn't the bank always going to push somebody to a normal IPO?
I guess the bank is going to push people to whatever makes them the most money. That is the bank.
Right, but does the bank really make the most money down here?
Well, I know that I'm not speaking on
Just-
behalf of. Why don't we let? Yeah.
I would look at Reg A as part of the company's overall life cycle, right? You're going to start out with venture capital, maybe some private equity, and as you continue to grow, you're not ready for a full-blown IPO. It's too costly, or you're too uncertain about the future of your company. But you see Reg A as a cheaper alternative that can leverage your customer base already and generate some buzz about your company because you can generally solicit. Then maybe in the future, if the timing is right, you can uplist to NASDAQ or NYSE. But it's part of the growth trajectory rather than an alternative or its own standalone fundraising
Right.
mechanism.
Right, but also remember, like if you're talking about a real IPO that's a firm commitment offering, you know, these guys have to make an assessment whether they want to actually buy the stock, and then they're going to be, you know, they're going to resell it presumably at a higher price, where there's a lot more risk and liability for them. And Reg A, in contrast, is a best efforts placement. So you'll file and say, well, you know, we want to raise up to some amount, but if you raise less, it's not like the bank really gets burned. You know, when the market turns, you have a lot of guys pulling their IPO deals because the bankers don't want to lose money. So, you know, in terms of the economics, maybe they're going to be safer economics, but also I would agree. I don't necessarily think that they're going to be, you know, designed for the same 3 minutes of companies. My eyesight is terrible. 5 minutes of companies. Do we have any other questions?
Did that answer your question, or?
Yeah, I'm just trying to figure what does it cannibalize late stage private market then?
I don't see it that way. I really see it as part of a growth stage. I was listening in on the SEC hearing for Clayton, and he talked about the lack of IPOs. Everyone who was going to an IPO was already a mature company, and there was nothing in this space of $10 to $50 million that was going to the public market. And this is a mechanism for that size of company. You can't necessarily leapfrog from $10 million to $100 million to do your full-blown IPO. You might need an intermediate stage.
Yeah, you know, it's sad in a big way that there aren't more public companies, because you go public to benefit from the liquidity and to raise capital at a less expensive price from the issuer's point of view. But you know the statistics. I mean, 15 plus years ago, there were twice as many public companies. And when I started publishing in the pipes business with the Pipes Report and whatever else we were doing, you know, every week there were deals coming public, whether they were through small stock IPOs or they were reverse mergers. You know, on an average year, I remember there were like 200 to 250 reverse mergers, which is, you know, one every other day. And I just don't get the feeling that that's really happening now. And the SEC maybe is tuned into that, and, you know, whoever else is out there lobbying for it. But, you know, Reg A, to the extent these companies eventually uplist and become liquid public companies, I think it's all good, and everybody should be promoting it. Ted, you have anything to add? And going once. Fred, you have any questions? Come on, Fred. I know you have questions.
You covered it all.
Okay. Well, we missed all the legal stuff, but we don't need to worry about the law.
Thank you.
Okay, thank you. Thanks.
Thank you.